This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest. I'm Mike Savino. We've been dealing with a lot of bad news in the housing market lately, with home buying becoming less affordable and more consumers stepping away. Well, now we may have some steps in the positive direction with the Biden administration this week unveiling plans to address the problem. Specifically, the Treasury Department is making it easier for local, state, and tribal governments to use federal funds for affordable housing. The Treasury Department previously said local and state officials could use some of their $350 billion from the American Recovery Act for housing, but now the Treasury is making it easier for officials to use the money for long-term loans for affordable housing, and they're expanding eligibility. The Treasury increased the list of government programs whose recipients can qualify for help. The National Association of Realtors says housing supply remains their top concern, and they celebrated this announcement. Any effort to add supply will alleviate a historic shortage in affordable housing. We're also seeing signs that buyers are coming back into the market, even if it hasn't translated into sales yet. According to Redfin, searches for touring activity and searches ticked back up, and that's caused the company's Homebuyer Demand Index to rise 15 points since mid-June, reversing a 10-week plummet that started in April. Redfin economist says we finally may be seeing the market reach an equilibrium. We may still be in for some surprises when it comes to inflation and rate hikes from the Fed, but for now, an ease in mortgage rates has brought some relief for buyers who were reeling from last month's rate spike. This bump in interest hasn't been enough to prop up sales. Pending home sales remain down, and the growth in median sale price is at its slowest pace since August of 2020. Of course, one way to boost sales and thus origination is to work with underserved borrowers, helping show them how they can get a home. In the latest edition of Ask an Expert, our own Christine Stewart talked with TD Bank about what they're doing.
We offer a $5,000 lender credit, and the purpose of the $5,000 lender credit is, as we look at how some of the reasons for developing the program, the median wealth for Blacks versus whites, it's 1/8 that of whites.
Home ownership is often viewed as the entree to the American dream and the gateway to intergenerational wealth. However, this pathway is less often achievable for Black and Brown Americans who have lower rates of home ownership than whites. So how do you get a piece of the American dream without resources? That's where TD Bank steps in.
Permits lenders to reach historically underserved communities.
Michael Innes-Thompson is head of community lending and development for TD Bank.
There is a need for more, access to capital to provide for down payment assistance or closing costs. So we're providing a lender credit that could be used for down payment and or closing costs.
He says they've also expanded their underwriting guidelines, recognizing that some in these communities have higher debt and lower credit scores.
Blacks and Hispanics historically have more debt, and according to Freddie Mac, have credit scores that are most likely at 660 or below.
But he says the program is stable.
We're not taking on significant risk here. This is just some incremental risk, again, around the edges that really doesn't create, safety or soundness issues for us as a bank.
And it's about the community.
This is about sustainable home ownership. So we were very thoughtful in how we crafted our program and the credit parameters to ensure that there was both safety and soundness.
The program was rolled out in March, just as interest rates were beginning to climb.
There was just a significant increase in mortgage rates. So I think at the time we rolled our program out, fixed rates were probably around the 3% range. They're running high 5%, in some cases 6%. Depending on where borrowers go. So rates have actually doubled, and affordability was an issue before our program was rolled out, and it's just an issue in this country in general. And doubling interest rates just really disqualified many borrowers from getting a mortgage.
How will you measure success?
We will assess our program periodically to see if it's working the way we would like to.
The program could evolve to look at more non-traditional sources of credit reliability, such as rental payments. For the Mortgage News Network, I'm Christine Stewart.
And finally, Fannie Mae reported earnings were down by a little more than a third from last year, but that wasn't the biggest news from today's earnings call. Executive Vice President and Chief Financial Officer Teresa Haley said Fannie Mae is still more than $260 billion short of being fully capitalized. This disclosure came a week after FHFA Director Sandra Thompson told Congress that Fannie Mae and Freddie Mac need $300 billion in reserves. As for earnings, Fannie Mae reported $4.7 billion in earnings, which was up from the first quarter. CEO David Benson said our solid second quarter results enhance our financial strength, and we remain focused on both managing risk and serving our mission to provide sustainable and affordable financing for the benefit of renters and homeowners.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.